Income Tax 2020 Tax Software Example, Schedule C, Self-Employment Tax or SE Tax. Come in, relax with Income Tax 2020. Here we are in our Intuit tax software. You don't need the Intuit tax software in order to follow along, although I do believe they have a 30-day free trial. So if you can get access to a demo version, it might be a good tool to use to practice with. We're going to be focusing in on the Form 1040, the related Schedule C for a business, for a sole proprietorship, and the related SE or Schedule SE, which is the self-employment tax for a sole proprietorship. We'll be jumping back and forth from the data input to the forms so that we can run different scenarios, the tax software making it easier to do so. We're going to start off with our standard starting point, that being a single tax filer, Eric Smith, living in Beverly Hills 90210, has the $100,000 of wages. We're going to start off with the W-2 wages so that we can compare and contrast that to someone having a business and see the changes as we do that. Then we have the $12,400 for the standard deduction or itemized deduction. That brings us to the taxable income of the $87,600. To see that in terms of a tax formula, we can use our worksheet to see the income up top, the $100,000 in the tax formula, $12,400 for the standard deduction, bringing us to the $87,600. Now, if I just let the software do the calculation for the federal income tax, the software is going to give us that $15,110. So I'm going to say this is going to be 15110, and we're going to compare and contrast that to the difference if we move the income to a sole proprietorship. One of the differences will be on page 2. That will be the tax calculation, not only including the federal income tax, but also other taxes, which will include the self-employment tax. So then I'm going to go back then to page 1. So here's where we stand. We're then going to change our income from line 1 here, W-2 income, to the sole proprietorship. So I'm going to go back to the detail and just think about what we have here in the employer. Notice this is where I input the W-2 information. Notice that we have the 100,000 wages here, and we also have Social Security wages and the Social Security tax. So in other words, we have already paid $6,200 in Social Security taxes if we had W-2 wages, which would be the employee portion, meaning that has already been taken out of the employee wages, as well as 1.45% of the Medicare. If we have Schedule C wages, then these two are going to be a factor for the self-employment tax, in essence, or close to being doubled, due to the fact that we will not only be paying the employee portion, but also the employer portion. So let's go ahead and delete this. I'm going to say, let's remove this. And then let's go to our Schedule C. I'm going to say, let's go on over to the Schedule C for our business. And we have our data up top. So we have the information up top. And then I'm just going to go down to the income so we can concentrate on our self-employment income related to the Schedule C. 100, I'm going to say income, let's say income of 125,000. And let's put an expense, which will be the accounting expense, because they're very important. That's the only expense that matters. But we'll just put one expense here. And then we're going to go back to the forms to see what the adjustments are. So now we, of course, have our Schedule C, the Schedule C being another income statement, the 125 in the income line, the expenses at the 25,000. That gives us the net income, in essence, on the Schedule C, the business income, which rolls then forward to the first page of the 1040, as we've seen in prior presentations, or it rolls forward, in other words, to the Schedule 1, where we have the 100,000, and then it rolls forward to the first page of the 1040. So now we're on the 1040. We see the 100,000. We also see the credit down here, or the qualified business income deduction, which could have an impact here of the $16,107. We might look at that more in the future, but obviously it is significant. And then on the second page, where we're kind of concentrating in on here, we not only have the income tax, which is now different now because of the deductions that we have with regards to the sole proprietorship. It's lower than it was before, but we also have the self-employment tax, which is where our focus is now, that $14,129 self-employment tax, which is based on the self-employment income. Now, note that we also get to deduct half of this. We get to deduct half of this, as we've seen an overview on a prior presentation on Schedule 1, above the line deduction. That then flows into the first page of the 1040 right here. Okay, so that's where our focus is right now on the self-employment tax. So if I go back to the Schedule C, once again, we have the 125 minus the 25,000. There's the 100,000, which is now on the Schedule C. This is what we're going to see that flows through to the 1040 to calculate the federal income tax, but it's also what we're going to use to calculate the Social Security and Medicare. Social Security and Medicare for most people is done for us because the government forces the employer to do all the work related to it when you're a W-2 employee. Therefore, they take your money right before you even see it and then just report it on the W-2 and just give that money to the government, and you're kept as in the dark about it as possible, right? But when you have an actual Schedule C, then you have to calculate it here, and you got to actually write a check possibly to the government, which is going to be a more painful procedure oftentimes. And so that's what will look like here. So we have this 100,000 then. We'll also need to be looking at the Schedule SE. So this is going to be the self-employment tax, which is basically payroll tax for a sole proprietor, remembering that we have to pay both the employer and employee portion in essence now, since the government kind of sees us as the employer and employee. So we saw our calculation in a prior presentation. I won't go into it in detail, but basically they're taking that 100,000, they're multiplying times the 0.923, and that gets us down to the 92,350. That 92,350 is then basically multiplied times the self-employment tax. And remember, the self-employment tax that we saw for W-2 income when they withheld it was 0.062 for the Social Security plus 0.0145 for the Medicare. That would be 7.65% for the employee portion. And then if we multiply that times 2, we get to the 15.3%. So if I take that 15.3 and multiply it times the 92,350, that's what's given us our 14,129. So there's the 14,129. It's basically the employer and employee portion of Social Security and Medicare. You could see it here. This is basically the Social Security portion, which is 0.062 times 2. Right, and there's the 12.4, and this is the Medicare portion, which is 0.0145 times 2, and there's the 2.9% there. They have to break them out separately because of the caps and whatnot. We'll talk about that shortly. But then the general idea then would be that this 14,125 is what then gets added to page 2. So this is going to flow through. It'll flow through to Schedule 2 here. There's the tax here, other taxes. Other taxes then flows through to the 1040, page 2. 1040, page 2, we see that 14,129, significant tax there. Painful thing to look at when you're sole proprietorship, and that obviously adds up to the tax there. Now, we also get half of that as a deduction because they're trying to mirror what would happen on the employer and employee side in a relationship with like a C corporation and their employee. So between the two of them, the employer and employee, they would get to deduct basically half of that as a business expense for the employer portion. So we should be able to take half of that and deduct it. However, we cannot do so on the Schedule C. I can't deduct it here because that'll adjust the 100,000 on which I calculated the 14 whatever first off. So I have to deduct it some other place if I get that deduction. So where are we going to put it? We're going to put it on Schedule 1. It pulls over to Schedule 1. Obviously, the software is helping us to do all this, but you just want to understand where all this is coming from. So if there is a problem, you could check it out, and if you have to explain it to someone, you can. There's the 7065. It then flows to the first page of the 1040. There's the 7065 resulting in an above-the-line deduction for federal income taxes, but not resulting in a deduction for payroll taxes, because obviously it's not deducting the amount on the Schedule C net income on which we calculated the payroll taxes, the self-employment tax, or self-employment tax, which is kind of equivalent to payroll taxes. So this is going to be a deduction for federal income taxes, not for the self-employment tax for the Social Security and Medicare tax. Okay, so that's going to be the general idea that we have here, right? We get the self-employment tax is based on the Schedule C. That's then going to flow through to the second page here where we have this added tax we have to deal with. And then we also get this basically half of it deducted on page 1. Now there's some other kind of weird things that happen. Like what if I have 2 Schedule Cs? Or what if I have like a W-2 income and a Schedule C? So let's think about and the reason for this is there could be a cap, right? There's a cap on how much you have to pay taxes on for Social Security. So in other words, we saw our cap here was at the 137.7. So let's just put our Schedule C income over that cap now, just to start off there. I'm going to say, all right, well, what if the Schedule C income here, I'm going to raise this up to 225,000, which will get us to 200,000, 225,000. And then if I go back to the forms, that means that the Schedule C is now at 200,000. That's over the cap for Social Security. What's that do to my calculation for this SE? Let's take a look at it. We're going to say now it's at the 22,431. So now we're at 22,431. Once again, it took that 200,000 times the 0.923, but then you see the cap is applied here for Social Security. So when I think about the Social Security part of this, remember the Social Security is employer portion 0.062 times 2. That would give us the 12.4%. So 12.4 times the cap now, which is the 137.7, gives us that 1775. But the Medicare portion doesn't have a cap. In fact, it could actually go up at some point. So we're going to say, okay, the Medicare is at the 184.7, the higher number, times the 0.029, the Medicare rate, and that's where you get the 5356. So that's where that cap kind of applies out, and the Social Security will stop calculating at the cap. So if you're thinking about someone and they're trying to estimate their taxes out, if they make a substantial amount of money over the cap, then you got to figure, okay, now the Social Security is going to be capped at that point. Now we also have a situation where we could be paying extra tax on the Medicare portion. So we could say, well, if Medicare is over a certain point, we have to pay another 0.9%, which isn't that big, but it would be over, in our case, the 200,000. So we're going to say, all right, well, what if we made, like, I added another 50,000 here, and I said, okay, let's add another 50,000 and say, okay. And then I go back on over and I'm going to say, all right. So now the Schedule C income is at 250,000, going back on over to the Schedule SE. So now we should have the same amount for the Social Security portion, because that's going to be still hitting the cap. So it's 0.062 times 2 times the 137.7, which is the cap, 1775. But the Medicare, you can see, changed here, and the Medicare is going to be equal to, we have the larger number, 230,875 times the 0.029, which is going to be the normal amount, and that would be the 6695. But then we also have the 8959 for the additional tax, and this is going to be form 8959, additional Medicare tax. So we're taking the amount over the 200,000, which is basically going to be that 30875 times the added rate, which is going to be, as we said, the 0.009, and that's going to give us our 228. That then falls in or flows into our Schedule 2, which includes the self-employment tax and then this added tax down there. So that's what happens if we basically go over the cap on that. Now, we could also have a situation where we have W-2 wages, and let's say we don't do as much work possibly on the W-2, and like it's gig work or something like that, which is like side work for us maybe, and then we get most of our income from a W-2. Now, the thing that's confusing there is that the W-2 wages, you're going to have Social Security withheld there, and you'll also have Social Security withheld or possibly need to pay the self-employment tax. Now, the thing is, the self-employment tax here, as we saw, is both employer and employee portion. So if you can choose which one you have to pay first, you'd rather pay the self-employment tax on, or the Social Security part of it at least, on the W-2 wages, so that you can hit the cap and only be paying like half, the employee half, rather than having to count the self-employment tax first, where you'd be paying both employer and employee portion. So in other words, if we go back to the 100,000 here, we're at the 100,000, but let's say that if I go back to the detail, we got our W-2 wages back in. So I'm going to say, now I got my W-2 wages here, and I'm going to call this employee, and I'm going to say that this is W-2 wages of the 100,000. Now, the employer already, well, let's make it even higher. Let's make it 200,000. So that hit the cap of the 137.7, which the software did automatically. Said, hey, look, your Social Security cap is right there. That would be on box 3, I think, in the W-2. Your Social Security wages would differ from box 1, federal income tax wages, and it already calculated the tax at that 8537, 6.2%. That's already hit the cap. So what does that do if I also have my business wages here? We're going to go back on over and say, okay, I already paid the Social Security. What happened? And I still have my business income, which is also, another 75,000 in this case. So if I then go to the self-employment or the Schedule SE, we can see then that it's going to be a lot lower here because we don't have anything on the Social Security because it capped out. We already capped it out. So you could see it's capped out here, and we're not paying anything on the Social Security because we hit the cap with the W-2 income. So if you're paying Social Security from multiple different sources, you still have that cap. And if you're going to hit that cap with a married couple, then you got to be careful in terms of who you're applying the wages to. You got to make sure that you're applying the W-2 income to the right spouse, so that you're applying out the Social Security correctly, so that the caps will be able to be hit correctly within the tax software. Okay, so let's remove this one. I'm going to delete this. I'm going to go back to the Schedule C, back to where we have, and let's make the income the 125,000. So we have 100,000 Schedule C income. Then I'm going to say Forms. And now there's a little bit of twist that happened this year because of some of the deferrals on the payments. So here we're back to our normal calculation, our self-employment tax of that 14,125. If you then go to page 2, we have a calculation here which possibly could calculate a deferral. So I might do some more research and get into this in a bit more detail, but you could see this is the maximum deferral of self-employment tax payments. And you can see here we have this calculation down below, and what they're trying to do is kind of allocate what might be eligible basically possibly for a deferral due to I believe it's due to the COVID-19 situation and deferral payments. So this possibly could be entered then in 12E on Schedule 3. So if I was to do that, if I was to say 4380 and go to the Schedule 3 here, and go to then Schedule 3 12E. So here's 12E. I'm going to jump to that data input, and I'm going to add here that 4380. This is if affected by the coronavirus amount on Schedule SE or H taxes to defer to either 12/31/21 or here. I'm going to hit the F1 just for a little bit more research on this cell. So you could hit F1 and get like the basic rundown here. Use the following input fields to enter information to be reported on Schedule SE. Not very much more detail provided there. It's kind of disappointing. But in any case, if I go then to the forms, then this schedule, that you can see it populates here on Schedule 3. If I look at the worksheet then, they basically have the calculation. There's the 4380, and then we have the 4380 there, and then enter 1/2 of the amount on line 7. There's the 2,190, and it says enter the smaller of line 11 or 12. You must pay this amount by 12/31/22, and then this amount on line 14 is the amount you must pay by 12/31/21. So and I'm going to close this out. Now this is going to feed into then basically the second page of the 1040, that 4,380, 1040, page 2. We see it basically down here in the payment items. So it's basically in the payment section. So we got the tax at the 2493, and then this is coming out to bring it to that 20,450. So it might do a little bit more investigation into that one once the instructions come out, but that's that for now. Now let's just think about a married couple now, just to check this out. If I was to say, okay, what if the filing status then, if I go back to the information, we have 2 individuals. They're going to be married filing joint. So I'm going to say married filing joint now. Go back on over. And so now we have the same 100,000 for the business, the 7,062. We have this adjustment to the standard deduction now, the 24.8. We have the qualified business income 13,625, and that gives us the taxable income of the 54,508. But now I'm going to go back to the data, and I'm going to say, what if this business was basically owned by both of them? Now, again, you got to check out the rules could differ whether it's a community property state or not. So you want to just be verifying on that. But the basic idea is that, well, If it's a partnership, then you would think you would have to report the income on a partnership return, which is a whole separate return, a 1065, and then use the K1s that would flow in to the 1040. But you would also think, well, that a taxpayer is now, although two people, which would technically be a partnership, they are now one entity for taxes. So couldn't I just use the same Schedule C? In other words, you're saying, well, they both own it and they are two people, therefore a partner, rather than a sole proprietorship, which is what we typically use the sole proprietor for, the Schedule C for, but they're married. So can't we just use one Schedule C instead of possibly two Schedule Cs if they're co-owned by a married couple, even though it's basically a partnership because they're one person for taxes? So, and you want to do that, and the reason you kind of want to do that is because if you look at the Schedule C, I mean, for federal income taxes, it'll basically be the same, most likely or possibly. But for the Schedule SE, then the caps could differ based on who's being applied the Social Security, and you would want both owners to then be allocated the proper Social Security so that when they have their benefits from Social Security, they both have been putting into Social Security, so that you can max out the benefits. So they should both get the benefits that they've earned when they get Social Security. In this case, if you only have the one taxpayer on it, then all the payments, the whole $100,000, is going to the one person with regards to the Social Security benefits. So what you'd like to do, like what you could do is go over here and say, okay, now it's not just the taxpayer or the spouse, but both. So both now. And then if I go back on over, it's the same 100,000 now. But now when I go to the Schedule SE, there's two of them. There's one for the husband and wife. There's one for both spouses. And now it's breaking out that 100,000 like you would basically do if it was a partnership for at least self-employment tax, for the 50,000 then going to Eric, and then the 50,000 then going to Jane. Now let's assume that one of these individuals had another W-2 wages. So then I'm going to go like, well, what if we had W-2 wages here? Then let's say this was for employee 2, and I'm going to say it's the spouse is having employee and other wages, and let's say they earned 200,000 over the cap again for federal income taxes. So that means they already paid their portion of the 8,537, their portion of Social Security. So then if I go back on over to my forms, you can see how that cap could have an effect here. So if I go to Jane, Jane has now capped out with her W-2 wages. That's why you got to make sure in the software you have it applied to the proper spouse so that the Social Security caps are properly applied and that the benefits for Social Security are being applied to the proper person so that when the payments go out at the end, it'll be there. So now we've got the self-employment tax applicable to her is only that $1,339, whereas if we think about Eric over here, the self-employment applied there is the $7,065. So if we add these back up, if we say, okay, 7,065 plus what's on Jane's side here, that would be the plus the 1,339. Then that's going to flow over to the Schedule 2 for the added tax of the 8,404, and then there's added Medicare too, and then that of course would then flow on to the second page of the 1040. Now you might start thinking, well, if I went back to the Schedule C, it would be kind of nice. What if the whole thing was owned? Now the Schedule C business was owned by Jane, as opposed to being by both. Then you would think possibly your self-employment tax would be lower, right? You'd say, well, what if like Jane, what if I went back over here and said, well, what if Jane was the only one that owned the business now, and she already has W-2 wages as well, and I went to the Schedule C and say, now it's applied to her. So now I'm going to go back on over, and now if you look at the self-employment tax, the husband is gone, Eric is gone now. Jane's already capped out on her Social Security. Therefore, she's not paying any Social Security. So now you've only got $2,678 that's flowing over to the tax on 2 here. And so you can see the tax is a lot less in that case. Of course, you want to make sure that, if they're a partnership, you're applying out. So you can have a significant effect on the tax here. So you want to make sure that you're applying it out correctly to who is the owner. And You want to make sure there's two sides to this. Obviously, you're kind of you want to do it however it's set up. If it's a partnership, you should be applying it to both of them. And then if and then you're thinking about two types of things. One is like you want to pay the least amount of taxes here, but you also want to make sure that whoever is legitimately contributing to the Social Security is the one that's allocated the Social Security, because in this case, like Jane is maxed out on her contribution to Social Security. She's not going to get any more benefits when the Social Security program is paying out, because you don't get any more benefits after you max out at the 137.7. And the husband, Eric, is not getting any benefit from it at this point in time, because it's not contributing to his contribution at the end, because none of it's being allocated to Eric. So you got to think about lowering. There's two sides to it: lowering the Social Security tax that you got to put in now versus the tax you're taking out. Again, if you had a choice between the two, if you had a choice between paying it now and getting the benefits later, I would rather not pay the Social Security, right? Because I have no faith that the Social Security will be there by the time I'm getting the benefits. But but if it's between having the benefits possibly be there or not, then I'd like to be having the benefits there. So just note that you could have a difference between. You got to be careful in terms of how you're allocating out the Social Security. You want to make sure you're doing it correctly. If you have a spouse situation where two individuals have some type of interest in the one Schedule C, and how you're going to basically break out that partnership kind of interest within a married couple.